Hello guys, welcome back to my channel. Don't forget to like, comment, share and subscribe. New York and London world stocks slumped on Monday as the growing risk of more aggressive interest rate hikes in the United States and Europe inflicted more pain on bond markets and pushed the dollar to new 20-year highs, just as recession fears mount. Federal Reserve Chair Jerome Powell, speaking at the Jackson Hole Symposium on Friday, said the Fed would raise rates as high as needed to restrict growth and keep them there for some time to bring down inflation running well above its 2% target. European Central Bank Board member Isabel Schnabel added to market unions. She warned on Saturday that central banks risk losing public trust and must act forcefully to curb inflation, even if that drags their economies into a recession, as investors woke up to the reality that rates would stay higher for longer even as recession risk grows. 2-year U.S. Treasury yields rose to their highest since the U.S. S&P 500 index fell 2% to its lowest in a month. The Dow Jones Industrial Average fell 49% and the Nasdaq Composite dropped 25%. European stocks fell 6% after hitting their lowest level in almost 6 weeks earlier, and Japan's blue chip Nikkei slid over 2%. London markets were closed for a holiday, while MSCI World Equity Index fell 7% to a one-month low. The message from Jackson Hole was loud and clear and not what markets were expecting, said Nordea chief analyst Jan von Gerich. Central banks need convincing evidence that inflation is coming down. That is bad news for the economy and risk appetite and raises the risk of a deeper recession if we get more rapid rate hikes. Investors ramped up US and Eurozone rate hike bids, with markets pricing in a greater change of 75 basis point hikes from the Fed and ECB in September. Fed funds futures priced in a hike as a 73% change. The Fed will hike by 75 basis points and see rates speaking at 3% to 4%. Markets are focusing on discussing the message of coordinated tightening from Jackson Hole as ECB and Fed appear to have recommitted to creating price stability. Yields are shooting higher and risk assets are quite a bit lower since last week, said Lars Paresolaki Merklin, senior analyst at Danske Bank. Much might depend on what U.S. Augustus payrolls figures show this Friday. Analysts are looking for a moderate rise of 28 following July blockbuster 52 again. Hunker down as investors hunkered down for front-loaded rate hikes. Gauge of equity market volatility shot up. The CBOE Volatility Index, widely dubbed the Wall Street Fear Index, rose to its highest since mid-July. The Euro STOXX Volatility Index, the European equivalent, jumped to its highest level in 6 weeks. The aggressive chorus from central banks lifted short-term yields globally, while further inverting the Treasury course of as investors priced in an eventual economic downturn. Two-year US yields surged to a hike of around 3%. The hike has since led 207 and far above the 10-year at 3%. Yields also jumped across Europe. This all benefited the safe haven dollar, which briefly shot to a fresh two-decade peak at against a basket of major currencies. The dollar hit a 5-week high on the yen and was last up 7% and 13, with bulls looking to retest its July top of 13. Sterling sank to a 2-year low around 1 as Goldman Sachs warned Britain was heading for recession. The euro dropped to as low as not far from last week's two-decade stroke off, but was last up 49% at 1. The Dutch September gas delivery contract dropped as much as 11% as Germany's economy minister said. He expected prices to fall soon as Germany is making progress on its strongest targets, with facilities nearly 83% full and set to hit its 85% October 1 goal in early September. Okay guys, maybe that's all from me. Thanks for watching and don't forget to like, comment, share, and subscribe. See you!